Thank you for tuning in to this brief video about the concept of percent funded. It's a simple but often misunderstood concept that's provided in the Reserve Study Report. In this video, I'll be going over what percent funded is, how it's calculated, and why it's important. What is percent funded? Percent funded is a measurement used by reserve study professionals to calculate the financial health of an association with respect to its reserve account. It's the amount an association actually has in the reserve account compared to the amount the association ideally should have at a specific point in time. Percent funded is calculated as the reserve account balance divided by the ideal reserve account balance. This is also known as the fully funded balance. Percent funded is calculated on an annual basis as a reserve account balance will fluctuate during the year as dues are collected and deposited and expenses occur. A simple example of this concept is a community which needs to replace a roof. We're estimating the cost is $10,000 and it will have a useful life of 10 years. For this example, we're ignoring interest, inflation, and taxes for simplicity. This new roof will deteriorate approximately 10% per year until it's exhausted its useful life at the end of 10 years and will need to be replaced. The amount being allocated to the reserve account annually should be an amount equal to the estimated depreciation of the roof each year. Since we estimate the roof is depreciating 10% per year, the amount being allocated to the reserve account ideally should be 10% of the total cost each year. This equates to $1,000. At the end of year one, the association ideally should have $1,000 in the reserve account. At the end of year two, $2,000. The end of year three, $3,000, and so on until the end of year 10. The association will have $10,000 in its reserve account, an amount equal to the estimated cost to replace the roof. This association has stayed at a 100% funded level in each of these 10 years, as the association had the ideal amount in the reserve account, an amount equal to the estimated depreciation to the roof on an annual basis. The association has minimized its risk for the need for special assessments, and the community is on sound financial ground. The roof can be replaced, and the roofer can be paid. The process then starts over again. A second and unfortunately more common example is a community which is not allocating an ideal amount to their reserve account. Again, this community B needs to replace a roof, which we estimate costing $10,000 and having a useful life of 10 years, again ignoring interest, inflation, and taxes. This new roof will deteriorate approximately 10% per year for 10 years until the roof has exhausted its useful life and will need to be replaced. However, Community B is now allocating only $500 per year to the reserve account. At the end of year one, the association will have $500 in the reserve account. At the end of year two, $1,000. At the end of year three, $1,500, and so on, until the end of year 10, when the community will have $5,000 in the reserve account, half of the $10,000 estimated cost to replace the roof. This community at this point is 50% funded, as the actual reserve account balance is 50% of the ideal account balance. At this point in time, the association will need to implement a special assessment on its membership or obtain a bank loan for the remaining $5,000. This association has not upheld its fiduciary responsibility to its membership, and the membership has been either special assessed or been required to pay off an interest-bearing loan. So, is percent funded important? Absolutely. It's an easy to understand measurement of the overall financial health of an association with regards to the reserve account balance in any specific year. This concludes our video on the topic. Thank you so much for tuning in. If you have any questions, please feel free to call or email at the provided information.